Well, the markets find themselves a little bit of steam for a rebound after last Friday's bloodletting, but is it the start of a recovery, or are we in fact looking at something more sinister once this rebound runs its course? That's the question we're going to ask here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is explore how all of this might play out in the week ahead with a much lighter calendar of scheduled event risk on the menu and a lot more opportunity for the markets to sort of find a path of least resistance. We'll start with a look at where the performance situation left us last week and go from there. This is what these markets did ultimately once the dust settled on Friday's volatility. And what we see here is, of course, very, very lopsided. We have dramatic declines last week in both the S&P and NASDAQ. That comes with a drop in yields, which, of course, is more intense at the front end of the curve than it is at the back, because all of this ultimately comes together as a consequence of a very disappointing jobs report, perhaps not even so disappointing at the headline, 70 odd thousand versus 110 expected. That's not that much delta, but dramatic revisions to the prior 2 months reports, to totaling a downgrade of 258,000 jobs between those 2 months. So cumulatively suggesting that indeed the economy is in much worse shape, or at least the labor market is in much worse shape than prior data suggested. Lots and lots of hand-wringing around that, of course, after the signaling from the Federal Reserve, suggesting that they were not wanting to jump the gun on rate cuts. But of course, the markets then looking at this data and saying, well, you will be compelled. And so the response, both disappointed from stocks about the state of the economy, but also because of now the missed opportunity to cut rates in July, and perhaps now a elongated period of delay. The next scheduled Fed meeting is in September, where they might do something. And of course, the odds of a move there have now jumped up, as we can clearly see in what the 2-year does here. Interestingly, crude oil manages to rally on net last week. It's sort of off on its own as we digest still in the ranges that have persisted over recent weeks following those spikes around geopolitics in the Middle East. Gold a little bit higher last week, 1.9%. Most of that move scored against the backdrop of this drop in yields. But the really interesting story here, aside from the Japanese yen, where losses are relatively mild because of its sensitivity to yields, the situation in the euro here, the other major counterpart for the US dollar, pointing to a nearly 2% decline. Now, that's not as bad as it was until this jobs report came out and gave the dollar a big knockback last week, but it showed very, very spirited recovery last week until this jobs report. And certainly the more hawkish Fed didn't hurt the cause there, but the situation very interesting now for the dollar, in that it's at something of a dividing line, as are stocks. And the question going into this week, of course, is will this momentum carry us forward, or is this move already spent? Now, of course, we can see the implications. The outlook for Fed monetary policy now in Fed funds futures envisions 5 rate cuts between now and the end of next year. The most interesting influence, of course, last week here was the jump from basically down to one rate cut for 2025 after the Fed going into the jobs numbers, back out to a pair of rate cuts, 55 basis points now on the menu, basically in line with what the Fed has been forecasting itself. It's looked for 2 rate cuts this year. The real disparity then is next year. The markets are looking for nearly 3 rate cuts, fully discounted here. There might as well be 71 out of 75 basis points already priced in. That's basically a rounding error. So we're looking at a situation seemingly here where the view for next year is a lot more dovish, even though the view for this year has basically lined up. The Fed already discounting these 50 basis points for this year in their forecasting, but only looking for 25 next year, which of course is a huge 50 basis point disparity with what the markets now see. Clearly, some sort of a growth risk continues to be on the minds of investors. And so with that in mind, the first piece of interesting event risk for the week, sparse though it is this time as compared to last week's avalanche of news, we are going to get to the service sector PMI reading from the Institute of Supply Management. The expectation here is that we are going to see a little bit of a pickup. This would be the second consecutive month of growth. As ever, these are done around an axis of 50, where that's neither growth nor contraction. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so for the services sector here, which of course is the lion's share of the U.S. economy, a second consecutive month of improvement after that shock contraction back here. And with that, we have a acceleration. So seemingly a benign set of numbers, but of course last week we pointedly had a disappointment on the manufacturing side of the same survey. It was expected to be in contraction territory narrowly, but not only did it not manage to meet that, but it actually deepened into this shrinking territory. The pace of contraction actually accelerated. So the risk here, perhaps, that services may go the same way. Now, a parallel PMI survey from S&P Global did suggest a buoyant service sector in July. So at least leading in from analog type of business survey data, we're looking at indeed a case for a bounce. So perhaps that's less market moving in that this much ought to be relatively discounted by markets already. The worrying bit would be if the internals start to look similar to the kind of thing we just saw in this manufacturing side of the equation, because of course here we finally started to see that contraction territory, new orders, and employment, and indeed in the case of employment, the contraction there has only accelerated in recent months. But not only did we get this deepening contraction in overall activity, but we had this overhang from the prices component. And of course, with the tariffs, that makes quite a bit of sense. But notably, over the past set of numbers, the prices component on the manufacturing side started to fall off, suggesting that with the tariffs notwithstanding, weakening demand is starting to weigh. And we are starting to see that really become a more cyclically worrying state of affairs, whereby whatever one-off factors happened here with this jump in the pricing structure, not surprisingly, it starts right going into the beginning of the year with the new administration coming in. But we are getting through the point where we have that one-off shock and perhaps getting into the part where the demand destruction becomes actually evident. And as ever, manufacturing is a little bit more cyclically sensitive than services. So if this is suggesting to us which way the wind is blowing, then we may have a little bit of an issue on our hands here with this ISM report. Later on, we are going to get a monetary policy announcement from the Bank of England that is expected to give us a rate cut. And as we can see here, over the past several meetings of the central bank, the path implied in markets hasn't really changed very much. And what that seems to be suggesting is that expectations are relatively well benchmarked for what this outcome is likely going to be. Now, the expectation is that we're going to have a 7-9 majority on the policy setting MPC in favor of the cut, that we're not going to have any votes for a hike, and that 2 people will abstain and vote to keep things unchanged. Now, that's basically an inversion of the count when we looked at it for the last policy meeting, where there was a narrow minority wanting to cut 3 out of 9, but then 6 out of 9 voted to keep rates unchanged. So it looks all relatively steady, and with how narrowly these implied curves are sitting to next to each other, it seems like there's not that much room here for a change in the market's perspective. But of course, that also creates the threat of complacency. And as we can see here, looking between now and the end of next year, the Bank of England is expected to deliver 58 basis points in cuts. So one more cut this year with some possibility of a second, and one cut next year with some possibility of a second. So we're sort of veering into the between 2 and 3 cuts now through end of 2026 kind of territory at 58 basis points, narrowly. And so the surprise risk here, of course, would be any kind of a growth assessment from the Bank of England that suggests, well, we are actually perhaps more concerned, or maybe less concerned, about growth, and the overall tally, despite sort of how well telegraphed this particular move looks, perhaps the overall tally now is off. And with that in mind, we have an interesting story here for the British pound. So this is an excellent kind of version of what we just saw with the dollar last week. It had a strong push higher here, in this case against the pound, and then Friday's jobs report saw a strong rebound, but we pointedly held this former range bottom and held underneath it. So the breakdown architecture, as it were, seems to still be intact. And if we get a Bank of England that perhaps starts to get a little bit more concerned about growth dynamics and give us a sense that we are looking at maybe a little bit more easing against that back story than is currently being priced in, that may help to sort of engineer this rebound in at least the idea that at this point a reluctant Fed, despite the jobs data, is not scheduled to do anything until September, with lots of data in between now and then. And in that time, the dollar continues to be the higher yielding of the major currencies. Unless something materially changes in the outlook for, say, the Bank of England this go-around in a more hawkish direction, that still makes the dollar appear relatively attractive, and maybe that helps to make this a correction that becomes a selling opportunity rather than the other way around. Now, thereafter, we are going to be looking at a set of import-export data out of China. And here, the expectation is that on the export side and the import side, we are going to see slowdown down to 5% year on year on exports. We can see then that this upswing around the beginning of the year and the front running of the tariffs continues to fade. Meanwhile, imports as a measure of domestic demand, or at least a window into it, that continues to be anemic, and the expectation is we'll actually get a 1% contraction this time. That, of course, continues to speak to this larger narrative that we've been observing in China, whereby for 9 consecutive quarters now in China, we have had de facto deflation at the economy-wide level. And in fact, in the second quarter of the year here with the latest Chinese GDP numbers, we've seen that deepen more so than this entire period, suggesting essentially that there is a near total absence of demand in China's economy, and thereby the whole of output, as it were, is on discount. And so we're looking at an economy that, were there to be a downturn elsewhere, were the US economy, say, to lose steam, the world's second largest economy would offer no real backup. In this sense, a similar story for the Australian dollar as a kind of barometer on global commodities demand. And of course, China is its largest export market. And so there's some direct sensitivity there. We can see, similar to what we just saw for the European currencies, a strong bout of US dollar strength, a very tepid attempt at going the other way on the jobs data, and then ultimately a situation where the former range seems to be getting retested, but the architecture of the breakdown appears to be intact. And so if we were to get a soggy set of Chinese figures here, sort of reinforcing which way the wind blows, seemingly since we established this top near the 66 figure, this might start to look like an opportunity for a trend that's developing rather than the start of a rebound in the opposite direction. And then finally, there is, of course, the implication for why all of this ought to come together as we consider what it means for stock markets and for sentiment writ large. We're looking here, of course, at the breakdown for US GDP data over the first half of this year. And as we've pointed out here over and over again, there is a tremendous amount of fuzz around the surge in imports in the first quarter, and then the retrenchment there in the subsequent quarter. There's a similar thing with inventories, where first there's a surge in inventories, and now it looks like those inventories are getting some degree of drawdown in the second quarter as companies attempt to shield consumers from the cost of tariffs. But the big part of this story is this right here: the shrinking contribution from consumption, because that accounts for 68% of overall GDP, where this is all, for the most part, noise. And what we find is that in the first 6 months of this year, we have the weakest 6 months of consumption contribution since the first 6 months of 2020, which of course is the COVID-19 recession. And so what ultimately brings us back to why the markets performed this way when they saw that jobs data, is the implication that were we to see the US economy slow in a material way, as these GDP numbers seem to imply, as perhaps the jobs numbers suggest, as the ISM numbers may start to signal, this recipe for global economic resilience, whereby we have the world's top three economies accounting for 58% of global GDP, the US, the Eurozone, and China, are set up such that the US is where the growth is and everywhere else remains anemic, then this is a single point of failure. And if, in fact, the US economy is starting to unravel from this, then there is no backup. And there is then a global and not just a US recession risk. And then, of course, those Fed rate cuts can't come soon enough. And so if, in fact, the Fed is resistant and growth in the US appears to start to sour, then this starts to be a lot of what is perhaps on the menu going forward, whereby risky assets take a haircut, interest rates continue to decline around swelling expectations, as we've seen, that the Fed is going to have to be more aggressive, if not this year, then certainly next year. And that may start to undermine the kind of resilience we've seen in cyclical assets, for example, crude oil. And then, of course, the most important question here for the dollar will be, is it a creature of yields or is it a creature of risk aversion? Because even with this decline at the front end around these swelling rate cut expectations for this year, overall, it has held up quite well, suggesting that maybe the dollar is regaining that risk-off haven of liquidity function and could rally even with stocks declining as growth expectations fizzle and yields fall. And that is macro money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also on with Chris for Futures Power Hour Mondays and Fridays, on with him and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Thanks for watching.